Hello everyone. In this recording we're going to go through some of our homework for Chapter 8. Chapter 8 is basically a continuation of Chapter 7, and the subject matter of these two chapters is dealing with the variances. The variances effectively are the differences between the actuals and the budgets. And we're taking a look at breaking up our variances, our flex budget variances, into two pieces. The overall variance is called a flexible budget variance, and we're going to break up that flexible budget variance into two smaller pieces. Those two smaller pieces, when we're dealing with overhead, are called spending variances and efficiency variances. So in this particular homework problem, what we have is we have a clothing manufacturer, and they make each suit with the variable cost of materials, labor, and overhead. In this particular problem, we're going to concentrate on the overhead in analyzing the actual overhead that we incurred versus what we used in our budget, what we applied. So what we have here, let's take a look at the far right in the information given. It says variable manufacturing overhead cost is allocated to each suit on the basis of budgeted direct manufacturing labor hours per suit. So what we're saying is the number of labor hours spent on each suit is going to drive the amount of overhead. Okay. For June 2017, each suit is budgeted to take 4 labor hours. All right, so each suit's going to take 4 labor hours, and our budget, meaning our predetermined overhead rate, our budgeted variable manufacturing overhead cost per labor hour is $10. So for every hour that we spend in labor, we are going to basically apply $10 of overhead. And that was a rate that was calculated before the year. It's called the predetermined overhead rate. The budgeted number of suits to be manufactured in June is 1,120. So that's how many suits we were expecting to make, 1,120. Actual variable costs for June were $40,824. So that is my actual number for overhead. That's how much I spent. For how much? How many suits did we make? 1,140 suits were started and completed. There were no beginning or ending inventories of suits, and actual direct manufacturing labor hours for June were 4,536. So we have a lot of information here that we need to break down and see how this all works. And once again, we're going to do this column approach to kind of break this down for us. In the first column, we have our actual number, and the author just flat out gave that number to us. It said our actual overhead was $40,824. Now, what we're going to do is, this is the actual cost incurred. Now, I'm going to come all the way over to the far right-hand column, which is basically the amount that we are going to allocate to our overhead, how much we're actually going to put into the WIP stage. And that is basically the standards allowed for this level of activity. All right, and so that's important because our original budget was for how much? This was the static budget. It was to make 1,120 suits. But how many suits did we actually make? I'm circling it over here on the right. We actually made 1,140. So we need to flex our budget to the actual level of activity. Or I should say we need to flex our budget to what is allowable for this level, the actual level of activity. So what we're going to do in order to come up with the flex budget amount, which is basically the amount that we are going to allocate to the WIP process, how do we get this number, 45,600? Well, we're basically going to take our standard rate, which is $10 of overhead for every hour of labor, so 10 times 4, times flexed to the actual level of activity, which is 1,140 suits. That's where you get your 45,600. When we compare the 45,600 to the 40,824, which is the actual cost incurred. The difference is, let me pull up my calculator. The difference is 4,776. And you can see the actual costs came in lower than what was allowed for this level of activity. That's why it is a favorable variance. So the overall budget, flex budget variance is 4,776 favorable. Now what we're going to do to break up this flex budget variance into two pieces, we're going to throw in this middle column. And this middle column is basically going to take the actual quantity, and in this case, we're talking about labor hours, 4,536 hours were actually used. So 4,536 times, remember, for every hour of labor, we're going to allocate $10 of overhead. That's basically the standard rate. So the actual level of activity was 4,536 times 10 equals 4,360. So this is kind of this middle number. And when I call this column 2. So when we compare column 1 to 2, we can see column 1 are the actuals. Flat out actuals is how much we spent. And the middle column is the actual activity times the standard rate. You could see using the standards, it came in higher than the actuals. This is a favorable variance, and this is called a spending variance because the difference here is the rate. Column 2 has the budgeted rate, and column 1 is the actuals. The actual rate is used here. So that's a favorable spending variance, 4,536. And then comparing column 2 to 3, this is called an efficiency variance because column 2, once again, this is the actual quantity, the actual hours times the standard rate. And the flex budget is the standard hours allowed for this level of activity. And you can see the standard hours allowed for this level of activity came in just a tad higher than using the actual hours. All right, so the actual hours number came in a little bit lower, so that is also a favorable variance. We were just a tad more efficient with our time than was allowable for this level of activity. All right, so the overall flex budget variance, we can break it down into two smaller pieces, the spending variance and the efficiency variance. Okay, in this next homework problem, we are going to take a look at both the variable overhead variances as well as the fixed overhead variances. And first, let's work through the variable. This is very similar to the first homework problem we looked at already. And so basically what we do, this particular company, they manufacture these units, and they are going to allocate overhead based on assembly time. And the budgeted assembly time here, which is given in the problem, is 2 hours per unit. All right, 2 hours per unit. So if we come over here in the far right, the data table that was given to us, we can see that the author told us that the static budget, which was the original planning budget, we were expecting to make 140 units, but how many do we actually make? 230. Our expected, or our actual assembly time is 391. And our original budget for overhead, predetermined overhead rate as we're calling it, $30 per hour. And we can see we have our actual variable and fixed costs, and we have our planning budget for a fix. This was given to us. And so from this information up here in the data table, we are now required to do our level 3 variance analysis. So let's work on the variable first. And remember what we have. We have this 3-column approach. All right, the first column is basically going to be the actuals. So the actual variable overhead, the author gave that number to us in our table, $12,144. And then what I want to do is I always like to go to column 3, this column, the flexible budget, which is basically this number is the actual variable overhead that is allocated in the WIP stage. And what this is basically it is the budget flexed or changed to this level of activity, what is allowable for this level of activity. And so how many units did we produce? Actual, 230. So come down here, 230, I'm down here, circling it. The actual level of activity, what is allowable? Do you remember we said that based on our budget, it's going to take two labor hours, right? 2 hours per unit. So the actual level of activity, 230 units, times 2 hours per unit, times the budgeted predetermined overhead rate, $30. The author gave us number that as well. So we should have spent $13,800 on variable overhead for this level of activity. That is the amount that is allowable for this level of activity. How much did we spend? $12,144. So we had the difference between this $12,144 and the $13,800 is the overall variance, the overall flex budget variance. And you can see it is favorable because the actual costs came in a lot lower, over $1,600 lower than what is allowable for this level of activity. Now what we're going to do is we are going to break up that difference between two smaller pieces called the spending variance and the efficiency variance, and we will do so by throwing in this middle column. This middle column, basically we are going to calculate the actual input. And so what is the actual input here? We're talking about hours. The actual is 391 hours times the standard rate of $30 per hour. We get 11,730. And so by doing that, when we compare column 1 to 2, they're both using actual hours, but the difference is in the rate. Actual rate is used in column 1. The budget or the standard rate is used in column 2. That is why it's a rate or a spending variance. In this case, using the actuals are a little bit higher than using the standards. I'm going to call this an unfavorable variance. And then when we compare column 2 to 3, remember the rates are the same in column 2 and 3. The difference is column 2 used the actual hours. The flex budget used the hours that were allowable for this level of activity. All right, and you can see using the actual hours came in a lot less than what was allowable. Let's call this a favorable variance. This would be an efficiency variance. All right, and so that is, you can see we're calculating the spending, and let me come down here so you can see it. The difference between column 1 and column 2, that is the spending variance, and it's unfavorable because the actuals came in a little bit higher. And comparing column 2 to 3, this is the efficiency variance, and as I said, it was favorable. When you add these two together, you get the overall flex budget variance. All right, which we see is overall it is a favorable variance. Okay, now let's move on to the fixed overhead. The fixed overhead, you can see the actual results. The author gave that number to us, 15,380. So let's put that in column 1. All right. There is no middle column here per se because the flex budget is basically the same as the static budget. All right. There's no such thing as flexing fixed overhead. Fixed overhead, the budget is the budget is the budget is the budget, right? There's no such thing as flexing to actual level of activity. That kind of goes against the grain of what a fixed expense is overall. A fixed expense, remember, remains the same regardless of activity. So it doesn't matter if we were wrong with the activity, the actual versus the budget. The flex budget for fixed should be the same. So that's why the column 2 and column 3 are the same. But that is not the amount. Just because we have a flex budget, that is not necessarily the amount that we are going to record when we do our journal entries to update the WIP process. We are going to allocate, all right, something different. And how are we going to do that? Well, we're going to take a look at the static, or the original planning budget. The original planning budget, we were expected to have $14,000 of fixed overhead. And so when we allocate our fixed overhead, we are going to allocate based on the number of units that we are producing over time. So how many did we originally budget for? 140 units. And we originally said each unit is going to take 2 hours of assembly time. So if we take the 140 times 2, we actually had 280 hours. 280 hours of budget time originally. All right. I want you to understand this. The 280,000. Now, how do I get my original fixed overhead budget per hour? Well, 140 times 2, all right, is the 280, as I've been explaining to you. So if you take your original budget of $14,000 for fixed overhead, divide it by this 280. Remember, this was the budget for fixed overhead, the $14,000. The 280 is the budget for the number of hours that I was expecting to spend on making these 140 units. That's where you get your $50 an hour. And so that $50 an hour, this is a key number, because that is the rate that we're going to use when we start to apply the fixed overhead to the accounts. And so what we're going to do is we're going to start to flex it to the actual level of activity. How many units do we actually make? 230. 230, each takes 2 hours to make, so 230 times 2, and we will multiply the $50 per hour that I just calculated. So we're going to actually allocate $23,000 of fixed overhead. All right, that's a lot higher than the $14,000 budget that we had. So effectively, we have our actuals to the left, and we have the allocation to the right, and in the middle we have our budget, which in this case, dealing with fixed overhead, the static budget and the flex budget are the same. All right, so the difference between the flex budget and the amount we allocate, that is called a production volume variance. The only reason for this difference is because production volume has changed from the actuals to what we originally budgeted for. Tremendous change, I may add. We originally were expecting to make 140, and we made 230. So certainly it is a big, big difference. And now the journal entries, and this is a very important part of understanding how this all works. You can see that we have our original journal entries for the variable overhead. The actual costs were $12,144, so that would be debited to the overhead account. Remember, this is a temporary account that will get closed out at the end of the year, and we're going to credit all of our accounts payable type of accounts. Remember, this is the amount that we owe. These are actual numbers. So we got to pay these payables. All right, and now what do we got here? The amount that we're allocating, our flex budget, $13,800. And so what we're going to do, that $13,800 is the amount that is going to be applied to the units that we are making. That is going to go into the WIP account with a debit, and we will credit the overhead, the variable overhead allocated account. All right. And last but not least, what we are now going to do is we have a journal entry where we're going to close out our overhead accounts, and we will establish our variance accounts. So the variable overhead control had a debit balance of $12,144. Well, I will get rid of that in this journal entry down here with a credit. The variable overhead allocated had a credit balance of $13,800. So I will get rid of that with a debit, $13,800. And the difference between the two, once again, is the flex budget variance broken down into the two pieces. As we said, the spending variance was unfavorable by $414. We calculated that down here, bottom right. The difference between column 1 and 2, if you will. Unfavorable variances will have a debit balance. And the efficiency variance, the difference between column 2 and 3, that was favorable in this case. Favorable variances have a credit balance. All right, and so these accounts, 414 and 2070, the last journal entry is to basically get rid of these variance accounts. And we're going to write them off at the end of the year to cost of goods sold, which is this next journal entry. We will write off or zero out the efficiency variance with a debit. Remember, we credited it up here, so we'll debit it to get rid of it. The 414 debit spending variance, we'll get rid of it with a credit, and we will close out these accounts, write them off, if you will, to cost of goods sold. They should be relatively immaterial, and in this case, relatively speaking, immaterial. And we're going to do the same type of journal entries for the fixed overhead. So once again, you come back up to your 3-column approach. So we can see the fixed overhead was $15,380. The flex budget was $14,000, and we allocated $23,000. Try to remember these numbers. Actuals $15,380. Budget was $14,000, and we allocated $23,000. So first journal entry for fixed is to record the actual overhead with a debit to fixed overhead control. We'll credit all of our payable accounts, etc. Remember, these are amounts that have to be paid. These are actuals. Second one is to allocate the fixed overhead to the WIP account. And remember, what we said is that will be allocated of $23,000. That is a debit to the WIP and a credit to the fixed overhead allocated account. And the next journal entry is now to close out our fixed overhead control. It had a debit of $15,380. I will close it out with a credit, $15,380. The fixed overhead allocated had a credit of $23,000. So at the end of the period, I will close that out with a debit of $23,000. And then we have our spending variance, which we calculated earlier as a unfavorable variance. So that'll be established with a debit. And we had our production volume variance. That was a $9,000 amount. All right, and then last but not least, we will close them out to the cost. Basically, we will write them off. Here they are, the debit and the credit, and we will write them off to cost of goods sold. All right, so that is not only going through the analysis for the variances for variable and fixed overhead, but also going through all of the journal entries. This is a very nice comprehensive homework problem. Okay, in this next homework problem, we basically just have 6 questions here, and it's really one of these buffet-style questions that really don't have an end. It's just asking to make sure you know how to analyze the data given to us. So you can see down on the data table down here, I'm circling it, this is what the author has given to us. So the author gave us the variable and the fixed overhead, gave us the actual amounts, and the flex budget. All right, and remember, with the fixed, the flex budget is the same as the static budget, and the amounts that we've allocated. You can see with variable, of course, the flex budget is indeed what we allocate. Fixed, remember, there is a difference, because with the fixed, we are going to allocate based on the actual activity level, all right, which is different than the actual budget. Okay, so, and then the author also gave us original budgeted number of output units. That was in the static budget, 897 units. Our plan is 2 machine hours per unit. the actual number of machine hours used, so the author gave us that actual number, and the author gave us our original static budget for variable overhead, $80,730. So this is all given to us, and we're going to have a need to look at this information as we answer these 6 homework questions. All right, number 1, there are how many budgeted number of machine hours planned? Well, what were the budgeted number of units? 897, and each machine hour we're budgeting for 2, 897 times 2. So our original budget is for 1,794 machine hours. Next question, the budgeted fixed manufacturing overhead cost per machine hour. So we're trying to figure out the original budget for fixed overhead. And we can see the original budget, the flex budget, which is the same as the static budget for fixed, 346,242 divided by, we just calculated 1,794 planned machine hours. If you do the math, the original budget for fixed overhead is $193 per machine hour. All right, 193. And number 3 is the same question, but not asking for fixed overhead, but variable overhead. What is the original budget for variable overhead cost per machine hour? And so the original static budget for variable is down here. I'm circling it, $80,730. Remember, this is before we started, so you can't take the flex budget for variable. It's okay for fixed because remember, with fixed, the flex and the original static are the same. So 80,730 divided by the same 1,794 machine hours planned equals $45. So $45 is our original predetermined overhead rate when we allocate variable overhead. Number 4, the budgeted number of machine hours allowed for actual output. And so we need to figure out actual output. Okay, so what is the actual or the flex budget for variable flex to the actual level of activity? All right, allowable for the actual level of activity was $86,130. That is what was flexed for this level of activity, divided by the predetermined overhead rate of 45. So we have calculated the number of hours allowed for this level of activity, 1,914 machine hours. That is the amount allowed for this level of activity. We had to back into it. And number 5, the actual number of units that we produced. Well, if we actually, for this level of activity, allowed 1,914 machine hours, and each unit takes 2 machine hours, so we'll divide by 2, 957 is the answer for the number of units that we actually produced. Remember, the original plan was 897, so we made more. And last but not least, number 6, the actual number of machine hours used per unit of output. Well, we have to look down here. The author told us, and I'm circling it, the actual number of machine hours used was 1,531, and we know we actually made 957 units. So we actually spent 1.6 hours per machine. We actually used 1.6 machine hours per unit. And the budget was 2, so we did better. We were more efficient with our time for sure. So this is a favorable efficiency variance if we were going to go ahead and do that one step further. But that is not asked of us in this particular problem. All right, in this homework problem, we are asked about variable overhead and the various variances. And so what we would do here, and unfortunately I don't know why the author is not giving us the actual solutions that we can actually visually see, but let me talk you through it. So basically what we have here is we have a company, Holland Company. They manufacture pillows. The original static budget, so this is the original planning budget, it was based on making 21,000 pillows, 0.25 machine hours for one pillow, at a predetermined variable overhead rate of $15 per hour. So when you do the math, the original planning budget for overhead was 21,000 times 0.25 times 15. And when you do the math, the original planning budget, 78,750. That was question A that the author was asking for. The original budget overhead, the original planning budget. Now, the author goes on and gives us what actually happened. So that was what was budgeted. Now, actually, we made not 21,000 pillows, but we made 23,200 pillows using 4,850 machine hours. Actual variable costs were $14 per machine hour. So if I take the 4,850 machine hours that were actually used times $14 per machine hour, that was the actual cost, you get a total, if you want to write this down, $67,900. $67,900. That was the actual overhead. $67,900. Now, the next question is, what's the spending variance? Well, the spending variance, once again, is the difference between the actual, which is the $67,900, and basically the actual level of activity times the standard rate. So what we will do is we will compare that $67,900, which is the actual, times an amount which is 4,850 machine hours, that's the actual hours, times the standard rate of 15. Well, when you do that, it comes to 72,750. If you compare the 72,750, which is basically the actual hours times the standard rate of 15, compare it to the actual of 67,900, you get a spending variance of 4,850. It is favorable because the actual amount is higher than what we calculated using the standard rate. And then last but not least, the efficiency variance. The efficiency variance is the difference between that 72,750 that we calculated, which was basically the actual quantities, the actual hours, in this case, times the standard rate. Compare it to the flex budget, which is basically the amount of hours that are not actually spent, but the actual the hours that are allowable for this level of activity. So how many pillows do we make? 23,200 pillows, right? And each pillow is allowed at 0.25 machine hours. So if I take the 23,200 pillows times 0.25 machine hours times the standard rate of 15, you are going to get a total of $87,000. $87,000 is the amount of variable overhead that is allowable for this level of activity. But when we used our actual hours, we calculated the 72,750. All right. In terms of the column approach, so this is an overall favorable spending variance of 14,250. Once again, if you were going to do the three-column approach, I know it's a little wordy with my mouth, but if you were drawing this on a piece of paper, column 1 would be the actual, which came to $67,900. That is the 4,850 hours times $14 per hour. If you were going to draw column 2 in the middle, that would be the actual hours of 4,850 times the standard rate of 15, or a total of 72,750. And column 3 would be the flex budget, which would be the standard allowed for this level of activity of 23,200 pillows times 0.25 allowed per pillow times standard rate of 15. That gets you to $87,000. So column 1, 67,900. Column 2, 72,750. Column 3, 87,000. And you compare column 1 to 2, you get the spending variance. You compare column 2 to 3, you get the efficiency variance.